Thank you, Maulik, for those kind words, and thanks to all of you. I was just telling Maulik during the break that I would have loved to have another half an hour of the previous panel because that was very interesting. And I hope some of this could be useful to you. Before we start off, I'll do a short intro of Great Eastern Shipping. Not all of you may be familiar with us. When you normally go on a roller coaster, you're not blindfolded. So we are on a roller coaster blindfolded in our business. And I'll show you that it's not an idle boast. I will show you some examples of how that works. And we looked at ways in which we can manage the risk of this business. And we've been pondering over it for quite some time. And so we've arrived at a broad conclusion that the best way to do it is to keep things simple. To reduce complexity in your life, you need, because this business is a really tough one to manage and ride through. So we'll go through what our principles have been in this, for managing this business. Just a short intro, we are India's largest private sector shipping group. We also like to think of ourselves as the most profitable shipping group in India and the most consistently profitable shipping group in India. And to take a cricket analogy, there are some batsmen who bat very well on flat pitches and make double hundreds galore. Some of them do exceptionally well on sticky pitches where the ball is turning square. We'd like to target to be good on all pitches. Whether the market is good or bad, we'd like to outperform. One of our equity investors did an analysis of a lot of global shipping companies over about 15 years. And we were in the top 10 percentile of, so they did a sort of metrics against two indicators. One was return on equity and the other was net debt to equity, peak net debt to equity. So basically the measure of the risk taken and the returns made. And we were in the top 10 percentile. I believe we were in the top 3 companies worldwide in that. So, that's something that we're proud of. The largest is not something that really matters to us because you need to manage the cycle well. And, but the oldest is something really to be proud of. My predecessor as CFO used to quote very often a famous shipping saying that there are old shipping companies and there are bold shipping companies. But there are very few which are old and bold because if you're too bold, then you're wiped out. So we have 2 major verticals. One is the shipping business, which is tankers and dry bulk carriers. And dry bulk carriers are of great interest to economists in the last few years. Everybody is watching the Baltic Dry Index, as Maulik mentioned. Everybody is watching it very keenly to see if it's a leading indicator of an economic turnaround. It isn't. And then we have the offshore oil field services business, where we provide drilling rigs and offshore supply vessels. So our total capital employed is 14,000 crores, and we are rated AAA for domestic currency debt since 1996. So for the last 20 years, that's something that we are proud of, especially considering the nature of our business. So we've had a robust risk management process in place for many years. Anyway, this is part of standard corporate governance practice. You need to have a proper risk management process. But let's go beyond that. And so what do we do as part of this? We continuously endeavor to identify risks. So what are the risks which are there? And again, and this is something that with 68 years of experience, we should be able to know what all the risks are upfront, right? Actually not, because new things happen all the time. And you need to keep learning about the kind of risks that you face and ensuring that you can mitigate all those risks. And you can at least watch those and ensure that they're not going out of hand before you can do something about them. So therefore, the emphasis on the periodic review of risks and the effectiveness of the mitigation measures. So there's an Apex Risk Management Committee which consists of the managing director, 2 executive directors, including myself. So that's the business head and the chief financial officer, 2 different people, and the company secretary. That's the Apex Risk Management Committee for the company. And the constitution of this committee is important, and we'll come to that in a bit. We strongly believe that this goes much beyond corporate governance and really will be the key to our continuing business performance over the the next couple of decades at least, and into the foreseeable future. And let's look at why that should be so. This is a risk management process. Normally it's part of compliance. It's a little bit of commercial stuff, etc. So to appreciate why this is so important, they say a picture is worth 1,000 words. And let me show you pictures which are worth a few million words. This is a Capesize bulk carrier carries between 150 and 170,000 tons of dry bulk cargo, typically iron ore or coal. This is what these ships were earning in 2008. In May 2008, these ships earned $190,000 per day, these ships earned. In fact, on one day, they peaked at $225,000 a day in May 2008, in the good old days. By November, December 2009, that rate was down to below $3,000 per day. And now if you draw a cash break-even line, depending on where you bought the ship, your cash break-even, but somewhere between $20,000 and $30,000 per day. And you can see what can happen to a company which is exposed to this business. Because your cash flows have changed dramatically from being 50 or 60% return on equity to minus 25% return on equity. And you're also close to going to bankruptcy because you're not able to meet your repayments if your ships are open. Again, and then it goes up and down, and then you have periods when you went up to 80,000, and here you are currently. So we're looking at, this has been and widely reported as the worst year since the Baltic Index started, which was 30 years ago. So we are down to, so we've been averaging about less than $5,000 a day for Capesize bulk carriers since the beginning of this year, and that's a terrible market to be in. So this is what happens to the price of ships when you have markets doing that. So the price of ships obviously drops off. So the ships which were priced before the boom at somewhere around $40 million, they were actually somewhere in the 20s, and they went up all the way to $150 million in May 2008. And then that dropped by the end of that year down to below $50 million. And now you can imagine the kind of stresses which are there. Let's say you bought a ship at $100 million before it hit the peak, and you funded it with $50 million of debt. And the ship's value is now $40 million. So you have a few bankers making calls to you and asking what you plan to do about the security value on your loan. And you can't do anything about it because all your ships are in the same boat, so to speak. So that's a kind of risk which we face, and that's why we need to manage this well. On the flip side, you also have risk where you were here and you didn't buy a ship, and therefore you were sitting on cash all the way up here. So you have risk of not making a return as well, because you were so risk averse that you did not invest. You just said, this is too high, I'm not going to do this. So you have the other side of risk as well, because there's a risk of underperformance. So this is a tanker. So just showing you that it might not be as dramatic as in bulk carriers, but it's as bad sometimes. And this is now at the lowest level that we've seen for a long, long time. These ships are earning $3,000 per day. And this is what happens to the asset values as well. When prices, so the prices probably will drop to closer to $40 million in the next 2 to 3 months, because that's how the market moves. And so these are the risks that we need to manage. We need to manage the risk of what can happen to your cash flows, the risk of what can happen to your asset values, what happens to your leverage. I like one phrase used by Mr. Mahalingam earlier in the day. The market participants live in the very recent past, and that is true of so many markets. So all the people who are buying ships here, here, and here were remembering this recent past, and that's why they bought ships here, because you were making so much money there. And that's where it really, the risk management and the management of this business comes in. So which brings us to rule number 1 of our business. And there happens to be only one rule, which is remember that it's cyclical and it's extremely volatile. And in this, we have an advantage. We have an organizational memory which tells us that we've been through a few cycles before. It's only if you started business in 2003, all you saw were good markets all the way up to 2008 when the market went bust. So having started business in 1948, we've seen a few of these cycles, and we always remember that there are cycles. There's always a tendency to think this time it's different. And again, as somebody said, that's the four most dangerous words in markets. But we always pinch ourselves and bring us back to reality and say that the market is cyclical, it will change. Now, this is not just a risk aversion saying that the market is cyclical. Remember, the market is cyclical. This also needs to be remembered in markets like today, when markets are at, for dry bulk carriers, the prices are at 25-year lows. You need to remember it when markets are very low, that they will get closer back to mean reversion. And that means if you buy when ships are low in value, you will probably make a lot of money when they come back to closer to market historical averages. So that's something that we need to, that we keep in mind all the time, and we keep reminding ourselves of. So critical thing is to find the balance between risk and return. You can try to reduce your risk to zero, but then you're going to give up a lot of opportunities to make money. You're going to get so defensive that you will just say, I'm not going to do anything at all. And you will be frozen in inactivity in the bad markets, because that's the worst possible time for doing anything. So in order to ensure that, so this is the first principle for us, that we will never be in financial distress. We will not default on our payment obligations, even in the worst of markets. How can you ensure this? Except by just putting out all your ships on time charter and earning 6% returns on them, which is a terrible return for a country which has a cost of capital which is much higher than 10%. So you need to ensure your ability to meet financial obligations even in the worst of markets. You need to maintain capability to buy even when cash flows are poor. Remember that you need to make a return as well. We need to meet financial return objectives, not just to avoid financial distress. So you need to meet that requirement as well. And you need to allocate capital well between subsectors. We have different types of ships. We have ships that carry refined products, ships that carry crude oil, ships that carry dry bulk products, ships that carry LPG. So, and sometimes the markets move differently. You need to be able to choose which one will give you the best possible returns. So those are the things that we believe will enable us to make a superior return and to manage our risk well. And this is where the composition of the Apex Risk Committee comes in and has to be considered. Typically, risk management is seen as a brake. The business people press the accelerator all the time, and that's the perception which is there. The risk manager has to be the brake on the business people who are pressing the accelerator. We want everybody to work as both accelerator and brake, to remember risks and to remember that you're in business to make a return. And so the composition of the risk management committee has two people who are in the business side of things and two people who are on the compliance and risk side of things. And that brings a balance towards risk management, so that we don't get so risk averse that we don't take risk at all. Because then there is no point being in business if you're not taking risk. So how do we ensure ability to meet financial obligations? When the market drops, the asset values drop 50% or 60% within the space of 1 year. When charter rates drop by 80% within the space of 1 year, what can you do about it? So let's see what we can do. You have to keep the cost of acquisition low. 50% of the cost of a ship, of the cost base of a shipping company typically is the capital cost. It's depreciation and or repayments. You can interchange those, loan repayments. It's interest cost. Those are related to the cost of acquisition of the ship and the leverage that you put onto the ship. And that's basically the only cost you can reasonably control in a shipping company. Most other costs are decided by the market. How much salary you have to pay, how much you have to pay for maintenance of your ship is decided by the market. They are big vendors and it's a big market there. So you need to keep the cost of acquisition low, which means you have to manage the cycle well. Second, you need to have some revenue visibility. And this again is something to be taken with a great deal of caution. We've had cases where people have fixed out their ships. So people have bought ships at the top of the dry bulk market, fixed out the ships on 3-year charter and thought that they were putting away the risk that they had taken by buying at a premium by putting away on a 3-year contract. But you need to look at the credit risk of the charterer, the capacity and the willingness to pay. Again, this is basic economics. So there are two things, right? This is capacity and willingness. And a lot of people came to grief because of this. They thought they were de-risking, and it turned out they were not de-risking. So you need to be very careful about when you put away your risk, if your counterparty is able to bear that risk better than you are. If it is a weaker counterparty than we are, so financially weaker than us, he's obviously going to be more stressed in a bad market, and therefore he's not going to be able to deliver on his promises in the bad market. Therefore, it is something that we like to have typically in a year, every 12 months rolling forward, we like to have at least 40% of our capacity covered. But we need to keep some capacity open because you need to be able to take advantage of market movements. So the other is low leverage, of course. You take less debt, you have more flexibility. And most important for us is to provide risk capital for bad markets. Bad markets can come for any reason at all. You don't know why the market is going to collapse next week, and it could collapse next week. So how do you provide for a market collapse that happens next week? So the way we do it is fairly simple, and there's no, again, rocket science to this. We provide for risk capital for the risks that we take. So let's just take a very basic example. Let's say we have a ship with an average cash cost of $20,000 per day. Very simple, basic example, over the next 3 years. And we are forecasting over a 3-year time frame because we're taking the lowest 3-year period going forward. So we put the low case spot rate. So this is sort of our risk case. We say that the lowest 3-year period for this kind of ship in the last 25 years has given a rate of $12,000 per day. And that is the case that we will provide for. We are not expecting that to happen, but if we go through that, we will have the capacity to ride it out. So the vessel can be put, on the other hand, the vessel can be put onto a 3-year contract at a fixed rate at $18,000 per day. So you can choose, either you keep it open with a risk of going down to 12,000, maybe you'll earn 30,000, maybe you'll go down to 12,000. But you can put it on a 3-year contract at say $18,000 per day. So what do we do about this? If you put it on their contract, your shortfall will be $2,000 per day for the next 3 years, which works out about a little over $2 million. If you don't put it on contract, your shortfall could go up to almost $9 million per year. Now, what do you do about this? You've done a calculation, you've got a risk. So what are you going to do about it? So we said we need to keep that money aside. If we're going to keep that ship spot, the money has to be kept aside. We are taking a level of risk which may entail our being short by $8.7 million or $2.1 million, whichever that is. And we need to keep the money aside for that risk that we are taking. So now this can be used dynamically as well. So let's say that we've kept aside $8.7 million because we are running the ship on the spot market. If we put it away on contract, we can save that risk capital by 8.7 minus 2.1, that's about $6.5 million. And let's say we can invest that $6 million in some other asset, and there's a great investment opportunity. Then you have to make the trade-off. I can reduce my risk here, add to my risk by buying another asset, but I think that will give better returns. But the fundamental principle is we are going to go into any market and any 3-year period prepared to ride out 3 bad years and the 3 worst years we have seen in the last 25 years. So that's a very basic thing that we have done. There is no rocket science in this, and I know a lot of you are very sophisticated financial market participants, and this will probably be disappointing to you, but this is how we run our risk models. We just provide for the bad case. Now, the question which could arise is, this is obviously going to result in your underperforming on your return criteria. But remember, I told you at the start, we have outperformed on returns 90% of international market players over the last 15 years. And today, and again, the proof of the pudding is in the eating. Today, the dry bulk market is at 30-year lows in terms of asset values, or 25-year lows in terms of asset values. Most companies are forced to sell because of their financial position. Today, we are one of the few players in the world who is buying. There was an article about it in one of the newspapers 2 weeks ago. We're one of the few players in the world who are out there buying ships. Because when, again, famous saying in the markets from a great investor, you should be able to invest when the blood is on the streets. And that's what we aim to be able to do. So Last slide, capital allocation is one of the keys to our success. So what is capital allocation? And the ability to dynamically change allocations between different subsectors that you operate in, crude, dry bulk, product tankers, LPG, etc. Because the capital is scarce, you need to be maximizing your return on the capital. So what can you do with that? So just one example, between 2006 and 2008, which was super boom time for dry bulk, you've seen that it went up to $190,000 a day. Tankers went up to $100,000 per day. We took money out of the shipping business. And it seemed like a crazy thing at the time because ships were then giving 50% return on equity. But we took the money out of the business. We said we are not going to invest any more into this business. And we took the money out of the business and funded our offshore oil field services business, which we set up from zero then. And that was among the best investment decisions that we've made. If we had invested that same money in shipping, today we'd be sitting at a return and an IRR of probably 5% over the last 10 years, so which, it adds up to a large amount of money. So that's one of the better investment decisions we made in terms of capital allocation, where we actually said, this market is overheated, let's go into another market now. So all this, of course, requires a high level of execution capability, and we'd like to think that our skills in this are comparable to the best in the world. We compete regularly with, the masters of the shipping business are the Greeks. We are competing with them all the time for the purchases. We find that we are often better than them in timing the purchases and sales of assets. And so the other thing in capital allocation is you need to be able to identify which sector is going to outperform. We have a research team which does research into this. We have a technical and operating team which can operate ships and any kind of ships. And therefore, we have the capability to identify ships that others don't want, which we think can make extra money, and that's what we do. So it needs an overall organizational capability to manage the cycle well, not just the ability to make market calls or the ability to fund a ship in a bad market. So I forgot to mention, between 2006 and 2008, in 2007, we peaked at 48 ships in the shipping business. We went down to below 30 ships in 2011. So we actually brought down our exposure in shipping because of the market view that we took and put all the capital into the offshore business. So again, this causes pain. The ships that we buy today will not break even in this year based on the current spot rates because they are making less than book break even. There is depreciation, there is operating costs, there is interest cost. But the bottom line is these ships will make money over a few years. It will make a great IRR. So you need to be able to take that short-term pain, which is reflected in the quarterly or annual P&L, and focus on the long term and the fact that you will make money in the long term. And finally, you have to create the capability to buy, and we like to think the wisdom to buy when everybody else is selling and is forced to sell. So with that, I'll end my presentation, and I'm very happy to take questions, suggestions, advice, critique of what we've just discussed. Thank you. Do we expect the markets will be poor? They're going to get, dry bulk has bottomed out because it was so bad in February this year that it's up at least 25-30% from then in terms of rates at least. Tankers have not yet bottomed out. They will probably be worse before they get better. But yeah, and there's going to be a lot of stress. There is already a lot of stress in the shipping industry, unfortunately. And the number of participants who are able to survive will be quite low. And people have found that it's not an easy ride in the business. So, but the cycle will go through, it's gone through these cycles. We've seen this before. The 90s were not a great period for shipping. You had probably 2 good years through the decade of the 90s. But then the 2000s were a wonderful period because you had 6 fantastic years. And that's how the cycle goes. You have overcapacity, and then you have then capacity getting constrained, and then you have a market boom.
Shiva, I have a question for you.
Yeah.
You mentioned about the risk of underperformance, and very rightly said $250 million you were setting up and did not put into the ship business and shifted somewhere else. Now, how actually did you manage? Because I'm connecting that with any fund manager sitting up with the piles of cash. When the market is booming, euphoric, you tend to make a decision which is like, because you want to be
Yeah.
part of the market.
Okay, so we had a lot of flag internally and externally. So analysts told us, why would you take money out of this business? The oil and gas business also was doing well at that time, the offshore business. But we took it out and put it into new construction, under construction vessels, which would come 2, 3, 4 years down the road. So immediately your current yield dropped dramatically when you take it out of a business which is earning 50% and you put it into something which is under construction. So we took flag from analysts as well, though we were still making 40% plus return on, 40% plus return on equity in those years. The bigger problem that we had was from people in the shipping business. They said, why are you penalizing us? We are providing you 40% return on equity, and you're taking money from us and putting it into a business that for the next 3 years is going to give you nothing. Okay, and putting that capital in. That was a huge struggle. And so I wish I could tell you that we didn't make investments in shipping at that time. We invested 400-500 million in shipping as well at that time. So we made our share of mistakes, with the difference that we made mistakes that we could afford. So we are not that wise. So we put money into shipping, but at least 1/3 to 40% of the money that we got in the business, we took it out of that business. But it was a huge struggle to take it away from the business people of shipping, because they said, why are you penalizing me when the market is so good? So that's always a struggle, right, in risk management.
And also a question, are you the accelerator or a brake? Being with the company for so many years.
I've got 2 feet, so I'm hoping that I can manage to be both at appropriate times. I tend to be, so the way we do it is like this, is that because when you develop the skill to be both, you need to have the devil's advocate. So if there is too much of acceleration coming, you need to put in the braking, which is at least to put the factors against the investment, and when it's too defensive, you need to put the factors against. So that's how we play this actually in the management team, where you look at everything from all angles, so that it's not one homogeneous view and one view which is heard, and then we go out and do stuff. Sorry, yes, question there.
Yeah. In last few months, I've seen container freight rates have gone up in last few months, while cargo has not gone up. So what is your view on it? Why do you think freight rates have gone up?
So container freight rates actually shot up in the last 2 weeks. Okay, so they've been, again, I'm not a user and I'm not a container market person, but I read the shipping news. A company has gone bust. A big Korean company has sort of filed for bankruptcy, Hanjin. And basically that capacity has got taken out of the market. And that's what is squeezing the market and leading to container rates shooting up. We don't know when it will come back, when those ships will come back into capacity. But broadly, that market is, again, difficult. Somebody asked a question about, whether globalization will slow down with, movements in various parts of the world. That's a concern. I don't think it will, but the pace of growth will probably come down. And the container fleet is built for a very strong pace of growth. So hopefully, as users, you will get cheaper freight rates, but who knows?
Hi, Shiv. You mentioned that you have been essentially investing money at when the prices have been low,
Yeah.
and taking money out when the prices are high. So effectively, you are in a market, and what you're able to do is buy low, sell high.
That's right.
And you have been doing it consistently because your records prove that. So my question is, how do you manage that? Because that's the biggest problem that any FX guy or any markets guy has. Buy low, sell high. So how do you manage it consistently?
So one is, I'll just correct you, we haven't done it consistently. As I said, we made our share of mistakes in the boom years, except that we made less mistakes than others. And so on a relative basis, we've done better. The way we manage it is just to remind yourself that the cycle is there. The second thing is that we are not focused on, and it is really critical. I can't emphasize how important it is not to focus on the P&L and on current yield. Last year at this time, we could have bought a tanker, a crude tanker, at a decent, at say $42 million, a 10-year-old tanker. And if you'd fixed it out on a 2-year charter, you would have got a current yield in dollar terms of 15%. Okay, it is extremely tempting to do something like that. And then you say that cost of debt is 3% for us. And you say, look at the return on equity that you can make. But there is no free lunch. And the price of that ship has dropped by 30% today. And you have to resist the urge to buy when yields are in your favor, when the current yield is in your favor. And it only happens when you take a generational view. It's a little strong. You need to take a view 5 and 10 years down the road, not about next year, this quarter's profit, next year's profit, or the year after profit. A cyclical business cannot work on quarterly profit, trying to meet quarterly profit targets. That's just a formula for disaster. So luckily we don't have those pressures that you would face as a forex dealer or trader. Sorry.
If you had a hedging strategy, would you hedge your freight or fuel oil successfully?
We have a hedging strategy which is time charters. The effective hedge that we have for freight is time charters. You can lock it out on a fixed rate for up to 5 years, though typically very liquid up to 3 years. You just give it out on a fixed rate contract to a good counterparty. So our hedging strategy is that we lock in at least 30% of our fleet on a 12 months rolling basis. Sometimes it goes up to 50% also, depending on the market view that we take. But that's about it. We try to keep everything absolutely simple. In terms of currency, we don't do anything much because we are a dollar. We have dollar inflows, we have dollar outflows for loans, operating expenses, etc. Fuel, again, we don't do too much. We are very, very inactive. So nothing exciting really. So it's really down to basics. Manage your business, and the other risks, just don't take any of those other risks.
Shiv, I'll take the last question.
Yeah.
This is a question from the young CFO from the delegates. With your experience, what is the basic piece of advice that you would like to give it to young CFO?
The only advice, so you have to be lucky first, in that you need to have a company, and this you have to have a company that is not too fussed about quarterly P&L. There is a huge amount of pressure. So, when I say that we are not fussed about quarterly P&L, because we have the luxury that we don't need to raise money from the equity markets. If you have to go to the equity markets, it is extremely difficult to ignore the pressures of the equity markets. If you're going to struggle for capital, if you have to go out there and fight for capital, you have to be very lucky not to have that. So we haven't raised equity in, I don't know how many years, probably 20 years ago was the last time we raised equity. That would have been a GDR issue in 94. So that's a little bit of luck in terms of the philosophy of the company. And also that you don't identify what it is that makes for success in your business. So in our business, what makes for success is managing the cycle well. It is not having, instead of 38 ships, having 50, 60, 70 or 100 ships. It is managing the cycle well and producing that return on capital. And that's what we've identified, and therefore we are able to keep it simple. And when the market noise goes around and says your competitors are growing, your competitor doubled in size in the last 3 years, you need to be able to resist that because you have it written down saying this is my objective for the next 5 years or 10 years or for this company for all time. We are going to go after being profitable and sustainable, not after being the largest company in this sector. So that's sort of broad advice that I would really give.
And that was a question from Pratik Gadia in the audience. So I now request Mr. Shubhu from Chela Software to hand over the memento to Shiv.